Good morning, everyone. Welcome to the room. As you all know, trading futures involves risk and is not suitable for all investors. The information and presentations for educational purposes, not a trade signal service, not intended to be financial advice. Hope everyone had a great weekend. Jumping back into the week, market's about to open in a couple of seconds. Start off by getting a read on the market internals. We're opening inside of yesterday's range, so no gap fill expected, or no 5-minute breakout trade. Minus 1.5 and minus 300. So you can see, going back to yesterday's gap down, today, as we open up, the first 5-minute bar is right within this previous day's range. Well, yesterday, Monday, the first opening 5-minute bar was below the prior day's range, or outside of the previous day's range. And we then can place, a bracket order. Where'd it go here? Monday. When we open up outside of the previous day's range, we can place a bracket order above and below that first 5-minute bar, and then whichever one gets filled, just a buy stop or a sell stop, in this case a sell stop, got filled, and then takes you down along with the short. But on days where we open up inside of the previous day's range, there can be a little more back and forth. The market still might move in one direction generally, or it might move for 30 minutes in one direction and then change directions. But the likelihood that we'll have a couple bars in one direction and then change is much higher when we're within the previous day's range. So that's why I don't take that setup on situations like that. Yeah, good question, Rick. While we're talking about that and letting the market open up, let's go back to yesterday's trade. So talked about entering, just buy stop above high, sell stop below lows. When you're trailing, and this goes for if you got in on a first 5-minute bar, if you got in on a reversal above the high of the low bar in a pullback, and regardless of the time frame, excuse me, it could be a 5-minute, 15-minute. Once I'm in the trade, my 6-tick stop goes out at the entry. Market starts to move. In this case, yesterday, next candle started to form. A couple minutes goes by. We break our signal candles low, start to sell off. As the market continues downward, once the candle closes and then the next candle forms, we can move our stop from -6 to 1 tick above the next candle. And then once, say, this third bar closes and the fourth bar starts to trade, we can move our stop up, which would be really the first movement of the stop above this first candle, above the third candle rather. Once the fourth candle closes and the fifth candle starts to trade, we can then have a bigger stop movement where we take our stop from above the third candle, move it above the fourth candle. So you're just always trailing the high of the previous candle until you get taken out. In this case, the market did kind of get a little shakeout right here where we traded one tick above the high, the low candle here, and then rolled over again. So getting taken out above the 73.25. Another method, if you want to be a little bit more conservative, rather than trailing each candle's high, you can let the market pull back, and as soon as we break the swing low, then you can take your stop from the original -6, put it above the swing high, let the market break lows, let the market pull back again. As soon as we break lows the next time, take your stop and move it above the next swing high, and continue doing that until the swing high is taken out. So you move your stop down, market breaks lows, comes back up, and then it breaks the swing high, and sure enough, we broke the previous swing high. I mean, this is textbook trend change. Market's moving lower in both 50% retracements and lower lows, lower highs. The market breaks the 61.8. We break the previous swing high by one tick over here, and then we can draw from lows to highs. Market pulls back, puts in a higher low at the 50% retracement, and then starts on its way in its uptrend. And that reversal, kind of late morning yesterday, that reversal was right down here at the 22.62.25. That's the next daily long setup. And so yesterday in the my market analysis video, I was talking about how the importance of breaking above yesterday's high, breaking above the hammer, will be a strong indication for the bulls. If we break down below lows and break these swing lows down here, 61.8, that would be a sign that the bears are taking over. But in the meantime, we're right in the middle, kind of sitting just near previous highs. So we'll see what we can get for today. Advanced decline line and tick and the breath all kind of evenly balanced here. I'd like to give it about 15 minutes for the market to settle out. Kind of have, if I pull up the 24 hours, pretty tight overnight range. We have a little bit of a trend change potential here. We include the overnight. Trending down, broke the 61.8 like we just talked about, and then came up here and broke this first little swing high. Let's see if this higher low on amounts to anything. If we can put another higher low in and kind of start moving up this morning. Volatility is still pretty low, but if we look at some of the other charts, Google, Netflix, Amazon, some of these bigger names were kind of putting in the similar pattern as we saw in the S&P. Dow was looking pretty much identical. NASDAQ also hammer formation, and Russell as well. Now, one other thing to consider is tomorrow we do have the FOMC meeting, and that could instill a little bit of pause in the markets today, and especially tomorrow morning, especially with everything that's going on in the U.S. Presidential realm. See, it was Apple was looking strong. Amazon, also keeping in mind the earnings announcements coming out for a lot of these, typically led by Alcoa back here last week. So we've got a lot of news that's going to be hitting the markets, both economic news and individual to earnings. So that being said, we should start to see a little bit of a rise in the VIX, and even though we've had a rise from where we've been, 12 and 13 volatility is pretty low. When you're trading in a really small window, a couple hours, which I think is very beneficial, you can break it up. You can look at trading the NYSE Open, the European Open, but just in small chunks. So years back, I would trade at the New York Open and then wake up again at night and trade the European Open. I did that for quite a while, actually. It got to be a little bit taxing on the life rhythms and other things. But having a focused window is really helpful. It allows you to be present and be active and not just sitting kind of multitasking at the same time and either missing something or taking boredom trades. But within that window, it's okay to take every trade that comes down to a 50%. regardless of what anchor point you're using or what the guy next to you is using as his drawing or her drawing, a 50% is a valid identification area that's telling us we're not buying or chasing highs and we're not selling or chasing lows. So that's an important thing to note to yourself, that even if a trade doesn't work out, if you're entering at a 50, your potential for that trade to be a winner, your risk is much lower at those levels. Those are valid entries. Waiting that first 15 minutes also kind of keeps us out of some of the early chop that we can see right away. If we would have just opened up and started taking the very first setup from lows to highs that occurred, the market kind of whipsaws back and forth. Same thing with that first 5 minute that we were talking about. The market can, on days where we open up inside the previous day's range, market starts in one direction and then boom, turns around, and yes, you might get a couple ticks or a point or so before the turnaround, but we're looking for a little more than that, a little more trending, a little more meat that we can take away. So I'm going to start drawing from highs to lows here. 2270, we'll call it 25. Now we've got some tails, a topping tail and then a bottoming tail forming here, but that's the first 50% draw in the morning. Really, it's just that first 5 minute bar that I stay away from. You can get some really good high-low bars, low-high bars back and forth in here, and you can even get some good 50% retracements on an inside day. It's just the likelihood that the market's going to trend strongly right off the first 5 minute bar is much lower. Ticks in a pretty tight window so far. Because if you think about, when the market is within previous day's range, it's more balanced. You've got bulls and bears that are kind of being evenly distributed. When we open up outside of the previous day's range, something occurred in the overnight to swing the market one way or another. Look at the large 50%. You can see we're from yesterday's low to the close, we're kind of hanging out right near the 50, but we did break it by a tick down here, starting to get a little bit of a reaction. So that's where I say, entering in a 50 is a lower risk entry point than just chasing the market down at lows after you see a move, or seeing the market start to move higher and then jumping on. So look at this last bar here, the fourth candle, big bottoming tail, and then boom, bears push it down and give it basically all back. And if we can break lows, then I will start trailing each candle's high. So right now, just leaving the stop at -6, letting the market kind of get going. I don't like to get too aggressive right off the gun, because the market can move a little bit back and forth. Okay, so now that this next candle's forming, I can move the stop from -6 to one tick above the previous candle, a 69.75. Then you can either put a target out at the -23 and trail, or use no target and just trail. So you kind of sandwich them on the way down, or just not have any target out there and just trail and see how long the trade lasts. So now that this next candle started forming, you can move the stop down to a 69, just one tick above the previous candle's high. -23 would be a 67.50, which we touched, but we didn't trade through yet. Now you can either leave your stop above, keep it at the 69. Sometimes, if you get a couple candles in the middle of a double bottom, it has a little bit more weight. But on the 512, when you get two candles like that right next to each other, double bottom, it can still kind of be a little bit of a reversal signal, if you will, even though they're just right next to each other, and it's kind of an inside bar, if you will. The other way, just like we talked about with the 5-minute, you can leave your stop at -6, let the market come down, break a swing low, and if we roll over here, we can even draw up, it's going to be really tiny, but the next 50%. And if we roll over and break lows, then you can move the stop from -6 down to one tick above the swing high and continue that method all the way down. So there's a little bit more aggressive approach and a little more conservative approach to trailing the stop, and that's the exact same this swing trailing method is exactly what I do on daily charts. Same with the trailing each candle. So now the conservative approach, trailing swings, you got your original stop at -6, market shows that it's trading in your favor, breaks lows, starts to get a little bit of a pullback, and then makes a new low. Now we have a swing low established. If we wanted to just print out this chart right here and draw, mark the highs and lows, we got a high, lower low, lower high, lower low, lower high. Now we've put in a lower low. We can take the stop from our entry, move it above the next swing high. Stop's a little bit further away, but it can keep you in for a little bit longer time frame, and then it prevents having to get in and get out quite as much. Some markets work better than others in terms of moving from point A to point B without any whipsaw action versus a lot of back and forth. Certainly since 2011, 2012, the markets have a lot more whipsaw action, due in part to the automated trading. Yep, you got it, Rick. Now on a day like today, where we've got a very tight tick range and pretty balanced market internals, we have the potential to fail, to not really move in 2, 3, 4, 5, 6 retracements in a row, but instead turn around and start trading in the other direction. Just as we saw with these candles here, you've got 2 topping tails, 2 bottoming tails, meaning the candle traded down and then closed basically in the other direction, giving you this big long tail. So the market traded down, the bulls pushed the market way back up, and then in the very next 5 minutes, the bears pushed the market all the way back down, what it just brought back up, what the bulls just brought back up, and then some. So that can be a little bit more difficult to trade in that environment versus getting trending market with 3, 4, 5, 6, 7, 8 setups in a row. But the next guy we have here would be a 22.6850. Just taking the first entry, it traded down to its target. This would be the next anchor point, the previous entry, down to lows. And it's okay if you go through the morning taking every single setup. Let's say you have first setup, short, takes a winner, second setup, draw the next short, and get stopped out. Well, that means the market's changing direction. So by drawing then from lows to highs, getting the first long setup, typically taking the first setup in a new trend, gives you the most reward to risk potential. And to combat a situation where you might fail a short and then turn around and the market fails a long, meaning the market changed direction twice, usually within 15 minutes, 10, 15 minutes. That's where my 2 stop out parameter came into play, because that ensures that if the market can't decide on a direction, I want to know as soon as possible. Well, if we fail a short and we fail a long, or whichever order, fail a long and then fail a short, it's only going to take me 2 stop outs back to back to know that the market has no decisive trend. And so 2 is all you need at most on the day. So then if you start doing the math, okay, well, a -6 and a -6 per contract, that's a -12. Well, one trade could give you a +12 without a ton of, it's not a huge reach to go 3 points in the ES. So a losing day, if you opened up and took a -6 and then another -6 back to back, and then shut down for the day, and then came in the next day, and you had one winning trade for +12, or even +15, 16. Here's our 68.50. I don't like the phrase making it back, but you can make up for a bad day just in one trade. And those are some of the numbers that kind of need to make sense when you're looking at things like expectancy or R multiple, or just looking at your trades. A lot of people say, oh, I've been trading this method, or trading, I tried this style and that style, and it's not so much about the indicators or the specific entry. It's more about how can I create parameters so that I can take stabs at the market, but also not lose so much in a day or a week that I can't end up profitable at the end of the month. So the 68.50 trades, we'll see if it rolls over here. And again, I kind of like to, especially, I'm sure you've noticed in the ES, the market will sometimes chop around or move slow at your entry. Maybe it kind of moves away a few ticks or a point, and then it comes back and it touches the 50 again. Maybe it goes in even a little bit further and you take a little heat on it. So if you get into a trade and then all of a sudden it moves 2 ticks in your favor and you move your stop to 0, break even, the chances of getting stopped out are pretty high. Now, years ago, you could use a variation of that, and as soon as the market moved a point or so in your favor, you could move your stop up a little bit. And so here's our break, and already down to the target. So again, if you want to trail, putting your stop above each candle's high. So previous candle was a 68, but we've already traded down to a 65, a 66 rather. Pretty small window, 68.50 down to a 65, but you know, still 2.5 points, but a pretty tiny trade. You can take that 66 profit, or you can leave it open and continue to trail. That's more of a comfortable, what makes you comfortable scenario. I'm a big fan of always keeping that trail stop, whether you put a arbitrary stop out there or not. It's just important to use the same method each time, because if you start by using an arbitrary target and then the very next trade, you know, it doesn't, let's say it doesn't come all the way to your target, and so the next trade you say you're gonna trail, and then it comes to the target and then reverses, and you say, well, I should have just done the other one. Now you're just always on the flip side, always on the back end of the trade. So like the last trade didn't quite, if you just used the trail stop, you would have been better off. Could have got a little bit more out of it by taking the profit. Well, on this setup, it may end up working out the other way where the trail stop keeps you in longer. And so on the whole, I'm a bigger fan of always using trail stops. So now previous candle is a 65.50 stop. So now your stop on the trail stop is already below the target of that previous negative 23. Now it doesn't always happen that way, but it allows me to kind of sit back and let the market tell me, okay, this is the exit point, this is time to get out, versus me trying to say, well, we've come down a couple points, I think the market is it can't go any lower, so I'm just going to randomly get out. Now using a negative 23 or a negative 61.8 as a target that you place out there when you enter the trade, that's different than just kind of going by feel and saying, well, I'm comfortable here. I want to take my profit at this random place. Here again, you get that little double bottom. So getting a little more aggressive, you can take your stop down above the high of the shorter double bottom, but you typically get taken out pretty quick. Sometimes leaving it above the candle that made the first low can keep you in, but the 512 can get moving pretty fast, and so sometimes it's tough to get it all in. Little spike here in conjunction with the tick spike. Could see another rollover. So that's 68.50 down to a 65.50, and just like we were talking about, you know, that there's your 12 ticks right there. That would be, you know, an entire day if you had a opening stop and then the next trade was a stop out. So let's say Monday you had -6, -6. Well, just that one trade, boom, there's plus 12. So 66.25 would be the next short opportunity. We do have a tick spike, but again, keeping in mind the context of yesterday, we're inside this previous day's range here, so there can be a lot of back and forth. even when a trade setup fails or breaks a 61.8, there's typically some sort of pause at the 50, regardless of whether the trade ends up rolling over and working or not. So there's, those are just indications that, there's a lot of traders out there, a lot of computer systems, because this style of trading can be quantified. You have absolute numbers, physical highs and lows on the chart that the computer system can grab, calculate 50%, place orders, that sort of thing. It's not nearly as subjective as just throwing an order out there at a support or resistance level. Support and resistance is important, but it can be a little bit harder to create a automated computer system with that. So breath opened at minus 1.5, we're at minus 2. Its decline line opened at minus 300, we're at just about minus 600. Ticks have established some swing lows and highs, so we've got a plus 550, a minus 650, so pretty balanced across the zero line in terms of the absolute high and low, but most of the ticks have been below the zero line. A little bit of a reaction at this 50, but a ton of follow through yet. Certainly we didn't break this swing low. The last couple 5-minute bars have been inside the bigger down candle. that's really our first break of the morning. Potential trend change down here. Before taking any longs, I want us to break this 5-minute, this big body candle to the downside, because currently we've got 3 candles that are inside this large body candle. This little one back here, kind of the same thing. We broke to the downside with this big body candle, but then the next candle broke that previous candle's low. But now we're in a situation where, well, we could still roll over, even though this 50% retracement broke. You know, if we were to come back all the way 50%, that keeps us in, that encompasses not only the full 50% of the morning where you're pausing right now, but this high at 68.75. I'll leave that drawn up for the time being. So yeah, there's our break above high. I'm not a huge fan of just buying halfway back of the day just blind. Typically, the range on the day is fairly big, and so the distance between the 50 and the 61 is going to be a little bigger. There's a bigger window there. Ticks are starting to make higher highs and higher lows as well. We can see if we get a little pullback into a 50% long. Remembering the daily context, there's that inside bar on the daily doji candle, and still holding above the daily 50. know if any of you caught that 60 Minutes over the weekend with all the motor doping that was being talked about in the show about putting motors in bicycles and things of that nature. I thought that was pretty interesting, looking at the timeline, and they interviewed a couple, or one of the gentlemen over in Hungary, the Belgium area, that had built a lot of these hidden motors, and they talked about the advancement of some of the motors in bicycles and being used in the Pro Peloton. Pretty interesting stuff. Just like in chess, trading, you're always thinking about the next step, trying to be a step or two ahead, whether it's planning out a couple scenarios, A, B, C options, or similar to a flight plan, or a pilot might chart out different scenarios, different options. A little reaction off of the first long, 67. So now as we break highs, we can take our stop from -6, and as soon as this candle closes and the next one forms, move it up underneath candle's low. So that low would be 68. 68.25 or 68. Still puts you, the trail stop locks in a point of profit here and allows you to keep it open-ended for more profit potential. Nothing doing on that one, at least temporarily. You may get another retest, which I'm not a fan of entering on a second test, because if the market can't make its move off the first test, if the bulls aren't strong enough or there aren't enough to push the market to its target, they were strong enough to make new highs, but then the bears took over or the bulls backed off. So it's riskier to take that second test. If the market retests, trades to its target, then I would certainly draw up the next setup and jump on board. So since the market wasn't able to begin a new series of highs, since we're inside the previous day, taking this short has a little more risk added to it. I dropped the short, but we have a situation where we break a high, a swing high, and we break a swing low. It's a much riskier scenario because there's indecision in both directions. Yeah, Travis, that's a good strategy to wait for the second one to trade in this situation where you've got a high break and a low break, and you're kind of, it's an inside day, and you're inside the first 30-minute range. Breaking below the swing low for the morning would be a good indication, and we didn't really get much of a pullback as it is, so there may be some opportunity, even though if we draw from highs to lows, we can see that the short was broken. If we do break below lows, may get a full 50% retracement. You may also just get a smaller 50% retracement where you can use this lower high anchor and then down to lows below this last swing low. Market's starting to stall out a little bit here. We'll wrap it up for this morning, kind of forming a double bottom and potentially either breaking a swing high and heading back north, or breaking the swing low and heading south. But not a bad morning for inside day, and I think we'll continue to see some pretty good movement even with low volatility. Be cautious tomorrow with the FOMC meeting and some of the earnings announcements if you're trading individual stocks, as well as any presidential announcements that may come out and shake up the market a little bit. So just keep your guard up, but good day, and I hope everyone has a good rest of the week. Feel free to shoot me an email if you want to chat more, and we'll talk to you soon.